Hello and welcome to the economics class with me Biraj Chetri, PGT Economics Kendriya Vidyalay Badkuhi. As you all know, we have been discussing about the chapter balance of payments in our previous classes. So today we will continue with the last part of this chapter, that is part 4 of balance of payments. And as you all know, we have already discussed about balance of trade in previous class. So keeping in mind that concept of balance of trade, we will further proceed with the concept of balance of invisibles or services, though this topic is not very much important from your board's perspective. But if you do keep this concept in mind, then if you get, let's say, 1 marks question, then you can easily answer the question. So just like the balance of trade, in case of balance of trade, we were dealing with the visible items, that is goods. So here, in case of balance of invisibles, we will be dealing with only services. And here also the definition remains the same, only we have to replace goods by services or visibles by invisibles. So here we see that the difference between the amounts of the exports of invisibles and the imports of invisibles, that is services or intangible items, is termed as balance of invisibles or services. So if we deduct import of services or import of services or import of invisible items from the export of services or invisible items, then we will get the balance of invisibles, or it is also known as balance of services. Okay, in the similar way, we can also write the definition of balance of unilaterals. In case of balance of unilaterals, what we will do is, since unilateral receipts is written on the credit side and unilateral payments are written on the debit side, so we can easily define balance of unilaterals as the difference between unilateral receipts and payments. When we deduct unilateral payments from unilateral receipts, we get the balance of unilaterals. That is, unilateral receipts minus unilateral payments will give us balance of unilaterals. Okay. In the similar way, we can also calculate balance of incomes. Here what we will do is, we will deduct income payments from income receipts. That is, if we deduct income payments from income receipts, that is income receipts minus income payments, then we will get the balance of incomes. Okay. So if we know the concept of balance of trade, then defining all these three will be much easier. Okay, we just have to keep in mind that in case of balance of trade also, what we have actually done is, whatever money we were receiving from exporting the goods, okay, we took that value and we reduced the value of whatever goods was being purchased by India, and we got the balance of trade. In the similar way, in case of balance of services, export of services minus import of services will be known as balance of invisibles or balance of services. In case of balance of unilaterals, unilateral receipt minus unilateral payments will give us balance of unilaterals. And in case of balance of incomes, income receipts minus income payments will give us balance of incomes. Okay. Now the next topic is balance on current account. What do we mean by balance on current account? Here also the concept remains the same, that is credit side minus debit side. Okay, so how will we define the balance on current account? We will define balance on current account as the value of credit side of current account minus the value of the debit side of current account. Okay, balance on current account means credit side of current account minus debit side of current account. So we know from our previous discussions that credit side of current account includes export of goods, export of services, unilateral receipts and income receipts. So this combined together is known as credit side of current account. On the other hand, in case of debit side of current account, we know that import of goods, import of services, unilateral payments and income payments are written on the debit side of current account. Now when we add all these components, that is export of goods and services, unilateral receipts and income receipts, okay, then we will get the value of the credit side of current account. In the similar way, when we add the debit side of current account, then we will get the value of the debit side of current account. Okay, when we add all this import of goods, services, unilateral payments and income payments, then we will get the debit side of current account. Okay, now when we add all these four, then we will be getting total credit side of current account. And on the other hand, when we add all this debit side of the current account, that is import of goods, services, unilateral payments and income payments, we will get the total debit side of the current account. And when we deduct this total debit side from the total credit side, then we will get the value of balance on current account. Okay, now just like the trade deficit and trade surplus, here also we may have current account surplus and deficit. In case of current account surplus, if you can relate it with balance of trade, that is trade surplus, we know that when export was greater than import, we used to get trade surplus. In the similar way, when the credit side is greater than debit side, we will get the value of current account surplus. Okay, so current account surplus simply means whenever the credit side of current account is greater than the debit side of current account, then we will be getting current account surplus, and in short form it is also known as CAS, cash. Okay, so in case of current account surplus, what will happen? The credit side of current account will be greater than the debit side of current account. Okay, in the similar way, there will be current account deficit also. It is written as CAD. Okay, here what happens is the debit side of current account will be greater than the credit side of the current account, and the concept is similar to that of balance of trade. In case of balance of trade also, the trade deficit occurred whenever the import was greater than the export, and we know that import is written on the debit side. So in place of import, we will just replace it by debit side, and in case of export, we will replace it by credit side. Rest of the things remains the same. There it was only about goods, here it is about the entire current account. Okay, now in the similar way, we may have balance on capital account also. Okay, now just like the current account, here also the formula for balance on capital account is, or the definition of balance on capital account is given by the difference of credit side of capital account and the debit side of capital account. That is, when credit side of capital account minus debit side of capital account, we will get balance on capital account. Okay, now we know that the credit side of capital account comprises of borrowings, investment from abroad and decrease in foreign exchange reserves. This we have already discussed in our very first class, isn't it? So on the other hand, in case of debit side of capital account, okay, on the other hand, in case of debit side of capital account, we get lendings. That is, whenever Indian firms or government or any individual gives loan to the foreigners, then it will be recorded on the debit side of capital account. Okay, so lendings, investment to abroad, that is, if Indians are investing outside India, then it will be included in debit side of capital account. And increase in foreign exchange reserves. Okay, whenever there is increase in foreign exchange reserves, then it will be included in debit side. When we add all these three of the credit side, okay, and on the other hand, we have to add all the three components of debit side, and when we add all these three, we will be getting the value of total credit side. Okay, if we add borrowings, investment from abroad, decrease in foreign exchange reserves, we will get total credit side. On the other hand, when we add lendings, investment to abroad and increase in foreign exchange reserves, we will be getting total debit side of capital account, and here it is total credit side of capital account. And when we deduct this total debit side from total credit side of capital account, we will be getting balance on capital account. Okay. Now, in the similar way, here also we may have surplus and deficit in capital account. Surplus in capital account or surplus capital account will occur whenever the credit side, again, whenever the credit side of capital account is greater than debit side of capital account. Only difference of this with that of current account is, in place of current account we will be writing capital account over here. So the credit side of capital account will be greater than debit side of capital account in case of capital account surplus, okay, or surplus in capital account. Okay, in case of current account, it is credit side of current account greater than debit side of current account. So we will just have to replace the name of the account here. Okay, similarly in case of deficit, debit side will be greater than the debit side will be greater than the credit side. Okay, debit side will be greater than the credit side of capital account. Now we will move on to another important topic of this chapter. You may get 3 marks question from this particular topic, that is difference between current and capital account. As we all know, current account transactions bring a change in the current level of a country's income. So current account transactions will only bring change in the income of the country. That is, the income of the country means the national income of the country. Okay, but capital account changes the capital stock, that is assets and liabilities of the country. So current account does not affect asset and liability, but capital account do affect the capital stock, that is asset and liability of the country. So asset and liability taken together is known as capital stock of country here, and in case of current account it affects only the income of the country, but capital account also affects the asset and liability of the country. Okay, current account is a flow concept. Flow means here all the entries are mainly measured in a period of time. We have already discussed what flow means when we discussed about the chapter money also. Here we see that flow means whatever is measured in terms of a period of time, that is, let's say a week, a month, a year. Whenever a particular variable is measured in terms of a week, a day, a month, etc., that is known as flow variables. Okay, so here whatever purchase, import or export is taking place, it is always expressed in terms of a certain time period. Okay, on the other hand, capital account mainly deals with the stock variables, that is, whenever we talk about investment on a particular asset, then that asset itself is a stock. In case of a stock, we deal with point of time. It is not a period of time, but point of time, just like say we can say at 4 p.m. on Monday, that particular time, point of time is mentioned over there. So mainly capital account deals with the stock concept and current account deals with the flow concept. Now the last difference is mainly based on the components of both the account. If you know the components of current account and capital account, you can easily write this difference. That is, components of current account, as we have been discussing, it comprises of visible, invisible trade, unilateral transfers and income transfers. On the other hand, it deals with capital account deals with borrowings and lendings, investment to and from abroad, and changes in foreign exchange reserves. Okay, so this is one of the important differences that may come in your board's exam for 3 marks. Now we'll move on to the next difference. This is also a very important difference between autonomous and accommodating items, and it may come of 3 or 4 marks. If it will come for 3 marks, you have to write 3 differences, and if it will come for 4 marks, you have to write 4 differences. Okay, now here we will see, first of all, we have to define what autonomous transactions is and what accommodating transactions is. You may get question, in question you may get the term as transactions or items. Don't get confused, it is the same thing. Okay, now here it refers to those international economic transactions which takes place due to some economic motives such as profit maximization. So mainly the autonomous transactions takes place with the motive of profit maximization, the goal with which the the goal with which the transactions is being taking place is because of the motive of profit maximization. So whoever is involved in the economic transactions, they will be bound by the goal of profit maximization. Okay, so in case of export and import also, obviously the parties involved or the firms or the households involved, those who are trading, the traders involved are mainly aiming at the maximization of profit. On the other hand, accommodating transactions or items is mainly undertaken to cover the deficit or surplus in the autonomous transactions. If there is deficit in autonomous transaction portion, then it will be covered by the accommodating transactions. Let's say if there is 100 crore rupees is deficit in case of autonomous transaction, then it will be covered by making certain changes in the accommodating transactions. Okay, it is independent of the state of BOP. Whether BOP deficit is there or BOP surplus is there, the autonomous transactions doesn't care about it. On the other hand, accommodating transaction mainly takes place whenever there is BOP disequilibrium, that is where whenever there is either BOP deficit or BOP surplus, then only accommodating transactions will take place. Otherwise accommodating transactions will not take place. Okay, it takes place on both capital and current account in case of autonomous transactions. Autonomous transactions comprises of all the portion of current account, and it comprises of mainly borrowings and lendings and investment portion of the capital account. So it deals with both type of account, that is capital and current account. On the other hand, accommodating transactions mainly occurs on the capital account side only. Accommodating transactions mainly comprises of the changes in foreign exchange reserves. So we know that foreign exchange reserves, that is the changes in foreign exchange reserves, is the part of capital account only. So mainly the accommodating transactions takes place on capital account only. Okay, it is also known as above the line items, and accommodating transaction is known as below the line items. Above the line items means those which are included in the autonomous transactions of BOP. Okay, based on this autonomous transactions itself, we say whether BOP is in equilibrium or disequilibrium. And on the other hand, in case of accommodating transactions, it mainly is taken in order to cover the balance of payment disequilibrium, that is deficit or surplus. So as a result of that, it is known as below the line items. We should know one thing over here. Before 1973, balance of payment disequilibrium used to take place. Okay, a balance of payment disequilibrium was allowed because foreign exchange rate was kept as fixed. So all the adjustment used to take place in balance of payment itself. But nowadays, after 1973, we are into the flexible exchange rate system all over the world. So what happens is balance of payment should always balance, that is the credit side of balance of payment and the debit side of balance of payment should be equal. So in order to make it equal, certain changes have to be made. Okay, if there is, let's say, surplus, then from somewhere the value has to be put on the debit side so that both credit and debit side should be equal. On the other hand, if there is deficit, let's say debit is more than credit, then some addition has to be done on the credit side in order to match the credit and debit side. Okay, we will understand it in details with this example. This is the balance of payment data of Government of India, and it is a quarterly data, April to June 2019. Okay, it is a preliminary data, and then April to June 2018 it is the actual data. This might change because it was a provisional or preliminary data. Now here if we see, okay, here you will find POL written over here in case of goods, of which POL means petroleum, oil and lubricants. Okay, now the basic thing for which we should look for is this, whatever is highlighted over here with yellow color. You will find that change in reserves, and this change in reserves is written on the debit side. Okay, so here if we add this value 160.7 and this value, okay, here if we add this value 160.7 with this value 141, then we will get a particular number, okay, 0.7, and this, when we add it, we will get 201.7, okay, on the credit side. And when we add this 175 and 127.2, then we will get the value, how much? 125, 175 is 200 and 202.2. Okay, and here we get 201.7. Okay, so here there is the difference that the debit side is greater. That's why we see that in case of errors and omissions, 0.4 is written over here in order to adjust it. Before that, we see that here the government have taken debit as 14. That is, they have increased the reserves. As you can recollect from the first lesson which we have done in case of balance of payment, okay, whenever there is increase in reserves, foreign exchange reserves, it is included in the debit side of the balance of payment. Okay, it is included in the debit side of the balance of payment. So here what is happening is, since this 14 is written on the debit side, so you should know that without inclusion of this, if we don't include this in this value, that is 127.2, then there will be balance of payment surplus. This portion actually is the autonomous portion or the autonomous items, and this actually change in reserves, which is highlighted by yellow, represents the accommodating items. Here 14 billion is included in the debit side, that is $14 billion was increased in foreign exchange reserves in order to balance the balance of payment, that is in order to match the credit and debit side of the balance of payment. Okay, in the similar way, here we see that now the change in reserves is on the credit side here in 2018. Okay, it is on the credit side. Why is it in the credit side? We see that here, without adding this 11.3 in 142.6, if we deduct 11.3 from 142.6, okay, we will get 131.3. So 131.3 capital account, and when we add the current and capital account, obviously we will be getting a deficit here. Okay, so balance of payment deficit on the autonomous item is there. So in order to match that, in order to match the credit and debit side, this 11.3 US dollar in billion, okay, is added on the credit side, and added means it has to be decreased, it has to be taken away, withdrawn from the foreign exchange reserves of the central bank, that is RBI. Okay, we have discussed about that in our first lesson, that whenever there is withdrawal of reserves, foreign exchange reserves from central bank, it is included on the credit side. So this much 11.3 US dollar, US dollar 11.3 billion has to be withdrawn from the foreign exchange reserves in order to match the balance of payment. Even after that also, if there is certain differences, then it is taken as errors and omissions, as we have discussed about this also in our previous classes. Okay, errors and omissions are taken because all the values may not be recorded correctly, so we consider a minimal value or the negligible value as the errors and omissions, okay, which were not actually recorded, which were not recorded in a proper way. So that compensation is done by the errors and omissions. So here mainly change in reserves or increase or decrease in reserves is mainly the accommodating item. Okay, that is the reason why it is also known as below the line items. If we see, all the items are above this, from this, above this we see that all the items whichever is written is known as autonomous, and below the line means if we draw a line over here, then below the line items is known as accommodating items, and below the line, it is known as below the line because it is mainly taken just to balance the balance of payment, that is just to make the credit and debit side of the balance of payment equal. Okay, hope you have understood. Now we will move on to the very last topic of this chapter, that is official reserve transactions. What do we mean by official reserve transactions? It is also related to accommodating items. If you see, there is not much of difference. The transactions carried on by monetary authorities of country, that is in case of India RBI, which causes the changes in official foreign exchange reserves, are termed as official reserve transactions. So whatever transactions is done by the RBI, and because of that transactions, if the foreign exchange reserves of the RBI is changing, then it is termed as official reserve transactions. And why is there the need for RBI to make changes in this official foreign exchange reserves? It is mainly because of whenever there is BOP deficit, the central bank or the RBI, how will it finance that balance of payment deficit? That is, how will it add money on the credit side of the balance of payment, so that the credit and debit side, debit side will become equal. The way in which the central bank will do it is reducing reserves of foreign exchange or the foreign currency. As we all know, if the money is if the foreign currencies are withdrawn, foreign exchange are withdrawn from the foreign exchange reserves, okay, then it is included on the, or the recorded on the credit side. So first option is that reducing reserves of foreign exchange, that is foreign currency, or borrowing money from monetary authorities like IMF. Okay, so borrowing money from International Monetary Fund, and whenever borrowing is there, we see that it is written on the credit side. Again, even though it is written on the credit side, it is the part of capital account itself. So we have discussed in the difference that accommodating items always takes place on the capital account only. Okay, so this is it. Sometimes you find that the definition of official reserve transactions is given in the boards, and how will RBI finance the BOP deficit. This particular question may also come of 3 marks or sometimes only 1 marks, that is related to the definition of official reserve transactions only. Okay. Now we will try to discuss some of the questions related to this chapter. First question is that it is a 1 mark question, multiple choice question. So here you see, a company located in India receives a loan from a company located abroad. How is the transaction recorded in India's balance of payments account? So first question is that a company located in India receives a loan from a company located abroad. So a company is already there in India and which is receiving a loan from a company which is located somewhere outside India. So how will you record this transaction in India's balance of payment account? So here you have four options: credit side of current account, debit side of current account, credit side of capital account, debit side of capital account. So first thing is that you have to realize whether money is coming to India or not. Since India is receiving a loan, that means money is coming to India. So obviously it will be recorded on the credit side. So how many credit side do we have on the option? We have two, A and C. Now we have to see whether it is of capital nature or current nature. Since the loan term is used here, we know that loan is a part of capital account because it affects the liability of the resident of the country or the company which is already operating in the country. So its answer will be credit side of capital account. Why? Because the money is coming to country and it is affecting the asset and liability of the resident of the country, domestic country, that is India. So as a result, it is recorded on the credit side of capital account. Now next question is, invisible items in BOP include foreign remittance, income from tourists, internet charges, all of the above. Now this is also multiple choice question. The answer for this question is internet charges, because here foreign remittance means it is a part of unilateral transfer. It is unilateral receipt. Income from tourists. Now whenever tourist comes to India from foreign countries, they may be spending their money either on services or on goods as well. They may purchase some food, they may purchase some souvenirs so that they can take it to their native countries back home and give it to their near and dear ones. So what happens is the tourists may spend their money in services as well as in goods. So we are not very clear whether the tourists have actually spent their money in services or not. But internet charges are always the services. That is, it is always invisible items. Internet charges cannot be goods. So as a result, its answer is internet charges. Okay. Now let us take few true or false questions. First is, unilateral receipts are recorded on the credit side of current account, whether it will be true or false. Export of tea is recorded on the credit side of capital account, whether it will be true or false. FDI by Pepsi company in India is recorded on the debit side of capital account. So you have to find out whether it is true or false. First is unilateral receipts. Obviously receipts means money is coming, so it is credit side, fine. And unilateral transfers are always included on current account, so this is a true statement. Export of tea is recorded on the credit side of capital account. Now export of tea is a good, and whenever there is export, money is coming to the country, so credit side is fine. But since it is goods, it is part of current account, so it has to be current account here. So it is capital account, so it is a false statement. On the other hand, FDI by Pepsi company in India. Pepsi company is an American company, so Pepsi is investing in India. Okay, so it is recorded on the debit side of capital account. Now since it is coming to India, okay, so money is coming to India, it has to be on the credit side. Though capital account is correct, but it has to be credit side, so it is also a false statement. Okay, now where will the following be recorded in the balance of payment of India? First, purchase of coffee from Ethiopia. Purchase. Okay, so money is importing, so money is going out of India, and what are we importing? Goods. So it will be recorded on the debit side of current account. Spendings by Indians on holidays in USA. Now Indians are going to some foreign countries. Okay, say here it is, Indians are going to USA to spend holidays. So obviously money will go out of India, and since holidays involves services and goods itself, so it is part of current accounts. This is also a part of debit current account. Okay, Apple, a foreign company, especially US company which starts investing in India, means money is coming to India, isn't it? But it is a part of FDI, investment in India. So it will be recorded on the credit side of capital account. Tata Motors open its subsidiary in Canada. Tata Motors is an Indian company. It is opening its branch in Canada. Okay, Canada is a foreign country, so money is going out of India. Obviously, it will be recorded on debit side. And since Tata Motors is investing outside, since investment, it will be included as investment to abroad, and investment to abroad is a part of capital account. So it is written as, sorry, it will be recorded on the debit side of capital account. Okay. Spendings by foreign tourists in Indian hotels. It is just opposite of this. Now foreign tourists comes to India, they purchases some goods, they spend money on services like hotel. Here especially it is written as spendings by foreign tourists in Indian hotels. Okay, so foreign tourists, that means money is coming to India, and since they are spending on hotels, hotel services, hotels means they are spending their money on services. Hotel services are always a part of invisible, so it will be recorded on the credit side of current account. Okay, hope you have understood this, how we have solved this question and answer. So here what you will do is, basically you will have to you will have to understand whether the money is coming to India or not, and whether the money which is coming or going out of India is affecting asset or liability or not. Okay, so main thing is to understand and learn, okay, the components of balance of payment, both current and capital account. If you know just the names of the components, then you can easily figure out whether it is on the debit side or credit side. If money comes to India, it is on the credit side, and if money goes out of India, then it will be treated as debit side. Okay, hope you have understood this. You will get many questions like this in your book, so refer to book and try answering those questions, and wherever you find problem, do ask to your teachers. Okay, thank you very much. So we have come to an end of this chapter, that is balance of payment, and there is one more chapter in this unit, so we will be doing that chapter also. Hope to see you again with the next chapter, that is foreign exchange rate. Till then, thank you very much.